Hi, it's Paul. So one of my mentors once told me, and I have to say I agree with him, is that you ultimately don't create wealth from running a business. You do though when you sell. So the idea is to sell often. So for most business owners, selling a business is mainly a once in a lifetime event. But for seasoned deal makers, selling multiple businesses is very much part of the course. So common triggers for a sale could be retirement or lifestyle change, maybe burnout or loss of motivation, succession issues, or trying to de-risk personal wealth, or capitalizing on peak performance. And the best exits, I guess, are planned and they're not reactive. And for me, as a sort of seasoned deal maker, I say all my businesses are always for sale. And really, what I mean by that is, when is the right time to sell? Probably when profits are stable and growing and customer concentration is reducing and founder dependency is low. But just waiting one more year can destroy value. So I'll give you two parallel examples. Someone I knew prior to the 2008 financial crash had his best ever year and was offered £1 million for his company. And he held out thinking that he could basically extract a better value. But then the financial crisis hit, and he struggled through those years. He spent another 4 years actually running that business, and he had to take on debt to navigate the challenges that were thrown at him. And when he did eventually sell the business, he did for 480k, some almost 500,000 less than what he'd been offered at the sort of peak of the market. And then looking at another, I think in the UK, there was a prominent London estate agency founded in the early 1980s by a gentleman called John Hunt. And that was sold in May 2007 to a private equity firm. And the deal was reported to be around 390 million, with Hunt's personally receiving around 370 million for his 97% stake. So, today that company is a public company. It was floated, I think, in 2013, but it has a market cap of 170 million. So the sale, I suppose, occurred during the booming London property market, just months before the global credit crunch and the UK housing market downturn that began in late 2007. So shortly after the sale, Foxton struggled with its leverage buyout, and within a few years, the business was taken over by its banks as revenues and valuations pulled back with the housing slump. And many commentators point out that Hunt exit timing coincided really with the peak of the property price inflation, which really allowed him to realize the value before the downturn hit. So, quite rare when selling a business, but it just shows how cyclical the market can be. So, how are businesses valued? Well, most SMEs typically sell for a multiple of maintainable profits. So usually that's on EBITDA or EBIT, or maybe adjusted net profit. And buyers are basically paying for cash flow, predictability, and transferability. Revenue growth alone doesn't guarantee value. So to maximize the value before you sell, let's use selling your home as an example. You wouldn't just put a photograph online and a sales sign outside and hope for the best. You'd probably clean the home, you'd put fresh flowers on the table, you'd present it in the utmost potential, and it's probably no different when selling a business. So let's talk firstly about financial optimization. Cleaning up the P&L, removing any personal expenses, normalizing directors' salaries, and stripping out any one-off costs, and build a sort of add back list of non-recurring costs, so personal expenses, for example. Maybe consider capitalizing assets, like plant and machinery, intellectual property, software. This can all help improve margins before exit. Look to reduce risk, so try and reduce customer and supplier concentration. Try and lock in long-term contracts where possible and demonstrate pricing power. Prepare 3 years of sort of statutory accounts, management accounts, being able to sort of produce monthly management accounts at the end of each month quickly versus wait until the end of the year for your accountant to do it. Really just show that the former business operates with discipline. I prepare forecasts and budgets to show future potential. Cash flow matters as much as profit, and get your systems in place and a succession plan. So, ultimately, buyers do not buy founders; they buy their systems. So, document sales processes, operational processes, financial processes, HR, customer delivery, and then those SOPs really reduce perceived risks. Succession planning really important. Who runs the business day to day? What happens if the founder exits on day one? There really should be a strong second tier of management in place, and then really make yourself buyer ready. So I probably prepare a data room covering, corporate, legal, financial, tax, commercial, customers, suppliers, operations, HR, etc. And when preparing, think like a buyer. You know, what would make me nervous if I was the buyer? And then if there are any issues, don't try and hide the problem. Honesty typically tends to get deals done, and dishonesty creates distrust, and deals don't get done. So be able to explain issues and offer solutions would be what I would recommend. A clean data room also speeds up diligence and builds buyer buyer confidence. I'd then probably prepare an information memorandum, two versions of this. So one is a teaser, anonymizing the business, giving it a headline view, and more detailed version that you can then release to a serious buyer that's under an NDA that shows strong interest. And this enables you to control the narrative. And a strong IM will include investment highlights, market positioning, financial performance, both historic and future, highlighting growth opportunities and risks, and how they're managed, not hidden. You could consider appointing a third-party corporate advisor or M&A advisor that can help you with all of that process, ultimately marketing the business confidentiality to targeted buyers. And I'd always probably start with a long list of who you think may be interested to buy the customers. So, buy the business. So think customers, staff, suppliers, competitors, private equity. Trying to get more than one party interested always creates tension and value. And a third party approaching people can act confidentially and help project manage the process to ensure that the right outcomes are yielded. So, you ultimately run the business whilst they run the process. So let's have a quick look at tax. So quick disclaimer, this is not advice. And if you're selling, do get specialist tax input. So in the UK, there's capital gains tax on the sale of shares. There are potential reliefs depending on the structure, such as, an employee-owned trust where you can essentially end up with a sort of 0% tax rate. Or if you benefit from business asset disposal relief, you can reduce the rate on the first portion of your consideration. Down under in Australia, capital gains tax also applies, but for small businesses, there could be concessions. So it's important to factor in superannuation and retirement planning considerations. So, for example, an aggregated turnover of 2 million or less, or net asset value of 6 million or less, the business must be an active asset, and shares or the business must generally have been held for a minimum period. So, for example, a business owned 15 years by an owner that's aged over 55 can essentially be exempt from capital gains tax, and up to 500 grand's worth of capital gains tax per individual can be disregarded if they're under 55 or the amount is contributed towards superannuation. Across the pond in the United States, there are federal and state capital gains. So there's differences also between asset and stock sales, stock meaning shares, and there's a few different legal structures to consider. So there's the C Corp. So essentially the company pays corporation tax and shareholders pay tax on dividends and sales proceeds. So there's no risk of double taxation. Whereas in an asset sale, the company is taxed and shareholders are then taxed again on the distribution. So in a stock sale, shareholders are taxed as one. There's the S Corp, which is essentially a pass-through taxation entity. So profits are taxed once at shareholder level, and there's no corporate level income tax. Whereas in an asset sale, gains flow through to shareholders with single level of tax, and in a stock sale, this is often cleaner for sellers. Built-in gains can also apply, converted from a C Corp recently. LLCs, most LLCs, limited liability companies, are pass through, so they tend to be single member entities and they're classed as a disregarded entity. Multi-members can be classed as a partnership, but most are treated as an asset sale for tax purposes, so it can hit sellers once at a personal level. So entity choice can really impact the tax treatment of the proceeds. So yeah, you can use that for negotiation leverage and deal structure. Many exits do tend to fail when tax isn't optimized until too late. And in the US, structure often does matter more than the actual headline price. Common pitfalls that can kill exits are, ultimately poor preparation, founder dependency, messy accounts, weak or no data rooms, accepting the first offer or letting emotion override strategy. So yeah, in summary, the best exits are engineered and not rushed, and the value is created before the sale process really starts. So selling well can change your wealth, lifestyle, and future opportunity. And for most sellers, not deal makers, tend to be you sell your business once, and how well you prepare for it really determines how well you exit. So if you've liked this video, do give it a thumbs up. It really helps the channel. And if you want to be notified when the next video is out, do click subscribe. If you're interested in joining our free Dealmaker community where you can connect directly with me and hundreds of deal makers around the world, then click the link in the description. But for now, happy deal making.